going to be in this video I'm going to be discussing the double declining balance method of depreciation. But first, I want to review you a little bit on the straight line method. You'll remember the straight line formula is cost minus the salvage or residual value, same thing, divided by the estimated useful life. So this problem, January 1st, 2028, Kemp Company purchased a machine for $20,000. The company estimates the machine's life will be 5 years. That is the estimated useful life. The residual value at the end of that 5 years will be $2,000. And then we're asked to compute depreciation for all 5 years using the straight line method. Well, the good news about straight line is it's going to be the same amount each year for depreciation expense. $20,000 is cost minus $2,000 residual value divided by 5 years gives us $3,600 per year. The entry for depreciation expense would be the same each year. Depreciation expense, debit, accumulated depreciation, credit. And you see the schedule for the depreciation below. So I have the depreciation expense each time. It's the same amount. Accumulated depreciation, so in that account it's just accumulated. At the end of 5 years, the actual book value then would be $2,000, which is the amount that was predicted or estimated at the beginning. Note over on the right hand side, this little area I've got for you, the straight line rate, 1 divided by the estimated useful life in this problem is 5. 1 divided by 5 would be 20. This is important because we're going to need this rate to help us with our calculations for the double declining balance method. Let's look at the same problem now, except we're going to use the double declining balance method. So to calculate the double declining balance method, you first find the straight line rate and multiply that number by 2. So in this case, the estimated life is 5 years. So straight line rate, 1 divided by 5 is 20%, 0.2. Multiply that straight line rate times 2 now. So 20% times 2 would be 40%. So now what we want to do is multiply the asset's book value. Each year it's going to change. Multiply the book value by that 40% each period. We disregard the residual or salvage value until the depreciable amount has been depreciated. So usually that's very close to the end of the useful life. Let's look at what that is going to look like now. I have the full schedule prepared for you. So look over here on the right, for year 1, 20,000 times 0.4 is 8,000. So the amount of depreciation expense for year 1, $8,000. Stretch this out just a little bit. And so you actually see the first journal entry there is recorded depreciation expense, $8,000 for the debit, accumulated depreciation, $8,000. So for year 1, accumulated depreciation would be the $8,000. Now what is the book value? Book value, scoot that over, make us a little room. So book value is equal to the 20,000 minus the accumulated depreciation. So that leaves 12,000. And I already have that in the schedule, but I just want to show you where this number is coming from also. So this is our 12,000 that shows up as book value. Okay, year 2. So now we're going to take that book value right there, multiply that times 40%, and that would be $4,800. So for year 2 then, depreciation expense, $4,800. This is year 2, which is 2029. Depreciation expense, debit $4,800, accumulated depreciation $4,800. So up in the schedule, you'll see the same thing. Depreciation expense $4,800, add the $8,000 plus the $4,800, we get a total of $12,800. What's our book value? $20,000, which was again our cost. You get one of those zeros out, that won't work. And now we want to subtract the accumulated depreciation, and we get a balance of $7,200. So that's my new book value for 2029. So going into 2030, take some of that bolding off so we can see where we're at. So going into 2030 now, I'm going to pick up that book value of $7,200, the ending balance, and multiply it times 40%. I get $2,880. So down at the bottom, you see that third journal entry, depreciation expense, debit $2,880, accumulated depreciation, credit $2,880. What does that look like in the schedule? And we really would have prepared the schedule first, so we would have all these numbers, but I just want to make sure you understand where they're coming from. The $12,800 plus $2,880 equals up to be the $15,600. So what is my new book value here? $20,000, the cost, minus that $15,680, leaves us with $43.20. So that's my new book value for the next period. Year 4, new book value $43.20. Multiply that across by 40% again. Notice that once we get that percentage, it doesn't change unless we have some sort of a change in estimate. So what do we need to do for this one? We're going to record depreciation expense, $1,728. Accumulated depreciation, $1,728. Back up to our schedule, $1,728. We're going to add $1,728 to the prior accumulated depreciation of $15,680. We get a total now of $17,480. Let's see how the book value is arrived at after that point. $20,000 minus $17,408 is going to now leave us a balance of the life of this asset. So remember, the company wanted to, or they estimated the residual value at the end of the life to be $2,000. That's where we need to stop when we get to the $2,000 mark. So if we took that $2,592 and we multiplied that times 40% over on the right hand side, you see, let me put that in some green, then you see we're going to be short, because if I did go over to the schedule now, if I did record depreciation expense at $1,037, that's going to make my accumulated depreciation $18,445. That means now I'm carrying a book value of $1,555. Well below the $2,000 mark. So scratch through that. What we have to do this last year is just force it, if you will. So because we want to have a remaining amount of $2,000 on the books, then I am only going to depreciate $592 on this asset here at the end. When I do add it to the $17,408, gives me $18,000, and now my book value, let me just go ahead and carry this through, minus the $18,000 gives us the $2,000, which is where the company wanted to end up, and that's where we are, so we're good to go. The entry, still going to be depreciation expense, but the amount is going to be the amount that we kind of forced it to there at the end, which is $592. Accumulated depreciation, credit for $592. Okay, that's a look at double declining balance. See how awesome accounting is?